Welcome everyone to Tax to the Max. I'm Lynn Nichols. This program is dedicated to sharing what I know about the federal tax law in education for CPAs since 1978. Doesn't seem like long when I say it fast, but it's been a long time and I've shared a lot of information, so we have some more to share today. What's in the program this month? and just be careful about ownership structure when you're trying to pass credits through to owners of a disregarded entity. And then what caught my eye was a ruling that disability benefits were included in a taxpayer's income. I thought disability benefits were excluded from your taxable income, but that's not so in every case. Next, fact sheets and FAQs on tax credits, 2 or 3 times in this month's program. A ruling on a Section 1202 small business stock exclusion in a retailer that was selling medical supplies but was not engaged in the healthcare business as such. I want to talk a little bit about the IRS push with Form 7203 for S Corporation basis reporting, and then to report that a U.S. District Court stopped an attempt by S Corporation shareholders to terminate an S election after a bankruptcy filing. I thought it was kind of clever on their part, but too clever by half perhaps. And a speech by the commissioner warning against abusive microcaptives, and the key word here is abusive. Microcaptives are okay so long as they are not abusive. And then a classic reasonable cause case, $510,700 in penalties at $60 each, because an employee who was entrusted with simply filing forms failed to do so properly, and automatically he's having some mental problems, emotional problems, and the employer doesn't have a system set up to catch that and gets hit with a $510,000 penalty. We'll talk about what constitutes reasonable cause with a little bit of speculation on my part. And finally, the characteristics of a capital asset versus an ordinary asset. I say finally, but I have a hidden surprise for you this month. First, an LLC cannot claim credits for a trust leasing of electric cars. The limited liability company is not entitled to claim the credits because it is owned by an entity that is not the taxpayer seeking to use the credits. According to the IRS, the LLC neither acquired the vehicles, because it's a disregarded entity, the owner of the LLC acquired the vehicles, and the owner of the LLC placed them in service. But the owner of the LLC was not the same person as the person who placed the vehicles in service. It gets complicated. They were acquired by a business trust, which is a disregarded entity, which was a member of an affiliated group. The taxpayer seeking this ruling has elected to be classified as a corporation and files separately from the group. You can see how this gets complicated. The trust allocated its beneficial ownership in the vehicles to the taxpayer, but the trust is a disregarded entity owned by parent of a group that does not include the taxpayer. First use includes offering the vehicles for sale or lease. Oops, a simple transaction, and the credits are lost by what I call over-planning. Next, Paul Christopher Caldwell is required to include disability payments he received in 2011 in his gross income for that year. He also failed to provide evidence to dispute the IRS's determination, and he's liable for additions to tax for failure to file a return and failure to pay taxes. From the reported record, it seems possible that Mr. Caldwell might have been unable to work due to problems with his perception of reality. Nothing to do with physical injury or sickness, and you don't have to be physically injured and you don't have to be ill in order to qualify for disability payments. And that's what this taxpayer has, disability payments, not because he's physically ill, not because he's injured,
but for some other purpose that gets him the benefits. It was close to $80,000 a year in disability benefits, taxable. Next, the child tax credit fact sheet continues to be revised by adding frequently asked questions. The fact sheet references FS 2022-29, updates a list of frequently asked questions about the 2021 child tax credit and advanced child tax credit to help eligible families make sure that they properly claim the credit when they're preparing their 2021 tax return. Now, we're rapidly approaching the end of the time when we could prepare a 2021 tax return. There are over 36 revised FAQs in this release in May. An S corporation is inadvertently terminated. Company is going to be treated as continuing to be an S corporation from the dates its subchapter S election was inadvertently terminated due to these events. First, a trust became an ineligible shareholder. And that's the most common terminating event for S corporations, where personal financial planners have helped wealthy individuals plan their S corporation share ownership by putting the shares into usually a living trust. But the shareholder dies, and now this trust, which is not a qualified subchapter S trust, is an S corporation shareholder, and if you don't get high behind and fix it, the S election will be terminated. But second, they weren't done yet, from the date of a later transfer of those shares to yet a different trust, which didn't qualify as a subchapter S trust either. All of this, of course, the permission granted by the IRS to avoid your inadvertent termination is provided that some conditions are met, and that's always timely filing by all the shareholders, treating the corporation as not having terminated its election. FAQs updated on the earned income credit. Question 15. Can I elect to use my 2019 earned income to figure my earned income tax credit for 2021 was revised in the affirmative, which is a bit of a shock. And that applies only if the 2019 earned income was higher than the taxpayer's 2021 income. But be careful, because taxpayers may not use their 2020 earned income to calculate the earned income tax credit on their 2021 return. You got all that? Want to do it again? You can use your 2019 earned income to calculate your 2021 earned income tax credit, but you cannot use your 2020 earned income. I don't know what they do when they make up these rules. The retail sale of drugs is a qualified business. Letter ruling 2022-21-006, for purposes of qualifying for the Section 1202 gain exclusion from the sale of small business stock, a company involved in the retail sale but not the manufacture of certain drugs was not in a trade or business involving the performance of health services. Had they been in a trade or business involving the performance of health services, they could not have qualified to exclude the gain on the sale of small business stock under Section 1202. New form. Well, it's not exactly new. It's Form 7203. It's been around for 2 years now. In 2018, the IRS started requiring shareholders to provide stock and debt basis information with their individual tax return if they claimed a deduction for a loss, received a distribution, disposed of S corporation stock, or received a loan payment from the S corporation. But compliance left a lot to be desired. That's the kindest way, I think, to explain that. So, a couple of years ago, the IRS tested this new Form 7203. Last year, they started to require it, but we still don't have really good compliance. And so I'm reminding all of you that if you have an S corporation shareholder who claims a deduction for an S corporation loss, receives a distribution from an S corporation under any terms and conditions, disposes of S corporation stock, or receives a loan repayment from the S corporation, you must attach Form 7203 to the Form 1120S. If you do not, it is an incomplete return. It's not a return without that information. And if it's not a return, then it's going to be subject to penalties for failure to file. 4 conditions requiring you to include a Form 7203 with the Form 1120S and the return of the individual shareholder. Claiming a loss from an S corporation, receiving a distribution from an S corporation, disposing of S corporation stock, receiving repayment of a loan from an S corporation. Any transaction where the shareholder's basis comes into consideration. Now, if you don't know the shareholder's basis, the IRS has published a series of practice guides, one of which explains how to calculate basis from miscellaneous information that you'll find laying around with every S corporation. You'll find that in the South Carolina Association of CPAs program on S corporation taxation and the preparation of the S corporation return for this year. Nice try, very clever, but the judge was not fooled. The bankruptcy court refused to dismiss a trustee's adversary proceeding against a debtor corporation's shareholders to avoid, and that is to not allow, a post-conversion C corporation tax return as an unauthorized transfer of property. This is an S corporation filed for bankruptcy. After it filed, the shareholders realized that even though the S corporation was bankrupt, there was going to be taxable income flowing through to them, and they weren't going to get any cash from the bankrupt S corporation to pay their tax, and so they marshaled all their superintelligence and terminated the S election. Can't do that. That's an unauthorized transfer of property. What property? Well, the money that's going to be saved by the bankrupt corporation by not paying the C corporation level tax. The trustee filed S corporation returns consistent with the S election that was in effect when the corporation filed for bankruptcy. The C corporation would have a tax liability, but the corporation shareholders would not. So they were trying to avoid the tax liability on the corporation's income. And yes, it can happen. A bankrupt S corporation can pass income through to its shareholders because it disposes of a lot of property and is going to file federal income tax returns. You got to pay attention to the small print. IRS warning against abusive, and I put that in quotation marks, microcaptives, because I have a couple of clients who have microcaptives. This is a speech at the Federal Bar Association Insurance Tax Seminar delivered by Commissioner Rettig. The IRS will be going strong everywhere. I don't know who writes his speeches. Against promoted abusive transactions. Pay attention. The IRS is on the warpath against promoted abusive transactions involving abusive microcaptives. If you have a client that has a legitimate use for a microcaptive, then the IRS is likely to simply leave them alone. The case that Mr. Rettig is referring to had serious fact problems. The annual premiums exceeded any exposure this corporation had ever had based on claims. And the pooling that it claimed for risk sharing was, in fact, a sham. The citation is Reserve Mechanical Corporation. The court had 2 grounds for declaring that Reserve was not an insurance company. First, they did not adequately distribute risk among a large number of independent insureds. All the insured risk was one company, had the same ownership as Reserve itself. Now, one of my clients that has a microcaptive has 5 automobile dealerships. Yes, these automobile dealerships have some of the same ownership, but not identical ownership. And the microcaptive ownership of the microcaptive is substantially different from the ownership of any of the dealerships. What do they insure? Well, they write rim and tire insurance. They write insurance that'll reimburse you for the cost of the car, a new car if you get in an accident when you drive off the lot. They're writing the typical kinds of things that insure against risk, unacceptable risk, but they're collecting premiums from the customers. Now, they also insure against some risks that 10 years ago I would have said, and the IRS would have said, don't exist. They insure against the risk that their supplier will file for bankruptcy. One of those dealerships is a General Motors dealership. They insure against the risk that they won't be able to get new vehicles. Read the morning paper, check the morning news, right? Now, Reserve tried to enter into an insurance pool with other purported insurance companies, but it was so cleverly structured that each of the companies in the pool was essentially reinsuring their own risks. That's an abusive microcaptive, and the characteristics are immediately obvious. One of those is that there's a promoter that's going to charge about $10,000 a month for administering your microcaptive. That's not the case with the microcaptives that I have. Zurich is doing the administration, and they are hardly an abusive promoter. So the policies were not insurance policies in the commonly accepted sense. The premiums were not reasonable. They weren't the result of arm's length negotiation. And the company was not operated in the way that legitimate insurance companies operate. And so the IRS has been given this perfect example of bad behavior that they're touting all over the country and trying to get everyone who has a microcaptive to quiver in fear. If you got a good microcaptive, keep it. If it's not abusive, don't worry about the Internal Revenue Service. Speaking of not worrying about the Internal Revenue Service, this concept of reasonable cause pops up in my work all the time. I do a lot of work helping people seek penalty abatement. This company down in Louisiana was in the payroll processing business, apparently. They had 21,000 information returns that had a foot fault, and they were sent back for correction. They filed them on time, everything's filed perfectly, but the IRS rejected them because the software didn't do what it was supposed to do. Now, the individual that was charged with taking care of all this clerical function, as far as anyone knew, he was pressing buttons and the software did its job. But when the IRS sent the returns back, this individual, who apparently had some emotional issues, wasn't able to deal with that his work had been rejected and had been returned, and he froze and he wasn't able to function, and he didn't refile the returns in time. The refiling was late. The original filing was on time. The refiling was late. The notices came in. They came to the employee who handled that particular task. There had never been any reason for management to check up on an essentially clerical task or to have any expectation that it wasn't properly done, nor was there any reason for the IRS to make sure they communicated with management, which is a point I certainly would have made if I was defending the taxpayer here. The IRS says, well, you didn't exercise ordinary business care and prudence. because you allowed this employee to handle this important job by himself. Well, okay, well, what about you exercising ordinary administrative care and prudence and letting the treasurer know, or letting the agent who's filed of record know that there's a problem, over $500,000 problem with late filing of routine reports. There's no income tax here. It's a foot fault, and it's much ado about nothing, except the IRS has already collected $579,000 from RSBCO because they are now appealing that. They've asked for a refund in the district court for the Western Louisiana Monroe Division. They want their money back. This is how you get into district court. This is how, if you want to, you can get a jury trial. You can't get those things in tax court. So let's talk about reasonable cause. Code section 6724 says that these penalties will be assessed unless the taxpayer can show reasonable cause, affirmative, and not willful neglect. So you must show this and not that, okay? The regulation is an administrative regulation. It's not an income tax regulation. It is a regulation across all of the Internal Revenue Code, every title in the Internal Revenue Code, in income tax, payroll tax, ERISA, all of it. This defines reasonable cause. The penalty here is waived for reasonable cause only if the filer establishes that either, and that's my emphasis, there are significant mitigating factors with respect to the failure as described in paragraph B of this section, we'll get to that in a minute, or the failure arose from events beyond the filer's control, some impediment, as described in paragraph C. Moreover, that's my emphasis again, the filer must establish that the filer acted in a responsible manner, both before and after, okay? Reasonable cause. An affirmative reasonable cause, not willful neglect. So, did I have reasonable cause to assign this clerical task to an employee? Yes. Could I possibly be guilty of willful neglect by not checking every jot and tittle that this employee was responsible for? Is there fault here? Was the employer acting in a responsible manner? What is that? A responsible manner is that the filer exercised reasonable care, which is that standard of care that a reasonably prudent person would use under the circumstances in the course of its business in determining its filing obligations and in handling account information such as account numbers and balances. They did all of that. And there was a glitch in the system. It shouldn't cost them $500,000 for what is essentially a foot fault, but you're going to have a good lawyer to take the IRS on, and you need to do what these people have done. What if they didn't have $500,000? They'd be in tax court, and they may not get the best deal in tax court. They know that they want to be in U.S. District Court because the appeal process from there would probably be different as well. And I'm an accountant, not a lawyer, so let me don't go too far down that legal rabbit hole. But I've been down this road with more than one taxpayer. I consider myself fairly well informed about Code Section 6724 and the concept of reasonable cause, and this taxpayer should get relief from the penalty based on all of the facts that I've read that are recited in the filings. $1 million loss is a capital item, not ordinary. William E. Musselwhite, Jr., a South Carolina attorney, a real estate investor. He had been an investor in 2 or 3 real estate developments, and those had all been successful. He through a series of interesting transactions that are described in the explanation of this tax court decision, he found himself involved in a difficult situation in 2007, 2008, when the bottom fell out of the real estate market, and he was doing his best to settle up some debts and get off some guarantees. And in one of those transactions, he disposed of 4 lots that he had acquired in one transaction. He acquired them in one transaction. They were carried in his tax returns as investments, and they were disposed of in a single transaction. Mr. Musselwhite never was himself a dealer on real property. He was an investor, he was a partner, and some of the partnerships in which he was a partner were dealers in real property, but this was not that. He couldn't color this transaction with the paintbrush that he had dipped in a different deal 5 years before, because not much had happened for a couple of years before these lots were sold in a single transaction. So they weren't his stock in trade, they weren't inventory, they weren't property held primarily for sale to customers in the ordinary course of business. They'd been reported as an investment on his federal tax returns. They were capital assets, and the $1 million loss on their sale is a capital loss that he can claim $3,000 a year. Hopefully he'll find some good investments somewhere. New optional standard mileage rates. Let's don't spend a lot of time here. The new business rate is 62.5 cents. The cutoff date is June 30th, 2022. For mileage before that date, it's the old rate. For mileage after that date, it's the new rate. Remember, the 14 cents is set by statute for mileage that's a charitable contribution, and that never changes. I told you I had a bonus for you, and here it is. The IRS has updated its cost segregation audit technique guide. Now, there is a lot of misinformation in practitioner circles that you can buy a cost segregation study on the internet and just fill in some numbers, and that's all the cost segregation study that you need. That's dead wrong. There are some promoters going around that say, listen, I just need a little bit of information, and I've got a program. I'll drop your numbers into this program, and we'll print this beautiful 200-page report, and that'll satisfy the IRS agent. It's not true. The Cost Segregation Audit Technique Guide gives the lie to those representations. If you're going to claim rapid depreciation and some tax credits based on segregating the cost of a structure, you need to be aware how the IRS is going to test that segregation report. You have to do a study, and you have to have a report. This is a 270 page audit technique guide. It is the be-all and the end-all for how to perform a quality cost segregation audit technique, or cost segregation audit, and how to draft a cost segregation report. What has to be done and what has to be in there. It's publication 5653. It's 261 pages. The IRS identifies the principal elements of a quality cost segregation study and report. And my personal take is that trying to use some rule of thumb approach instead of actual qualities or quantities and quality is a really risky business. So here are some important points from that cost segregation audit technique guide to follow. A bit of background. The underlying incentive for preparing these studies for federal income tax purposes is the tax benefits that you're seeking to get by a shorter depreciable life than a building. So this includes bonus depreciation, it includes Section 179 deduction, and it can also include some certain tax credits when those are available under federal law. So examiners, who are the subject audience for this book, need to understand both the rationale used to segregate property and the methods used to allocate total project costs among those components. There are 6 cost segregation approaches. They are discussed in Chapter 3 of this guide. Detailed engineering approach, detailed engineering cost estimate approach, survey or letter approach, residual estimate approach, sampling or modeling, and rule of thumb. Now I selected those colors myself. Green, safe. You do that, and the IRS may inquire and sniff around the edges of your cost seg study, but if you've done the seg study that way and your report's well done, you're not going to have changes. Yellow, be careful. Caution. That is not so sound. Red, stop. As I said in my beginning remarks about this, the sampling or modeling approach where the promoter drops your numbers into a model and they give you a report is just so much horsepucky. The rule of thumb approach is even worse. So don't waste your money, don't waste your time, don't waste your client's confidence on sampling or modeling approaches and a rule of thumb approach. Regardless of the length of the study or the methodology, the study and the report should always classify assets into property classes, explain the rationale, including your legal citations, for classifying assets as either 1245 or 1250 property. They're all 1231 property to start with, of course, and substantiate the cost basis of each asset individually, and reconcile the total allocated costs to the total actual costs. A quality study contains a number of characteristics which are listed in the next slides. I couldn't get them all on one slide, so it's plural. Here we go. The elements of a quality study are preparation by an individual with expertise and experience. That's not you. Unless you're an engineer or an architect, if you're a CPA whose primary work is preparing tax returns, you are not an individual with expertise and experience in cost segregation studies. 2, a detailed description of the methodology you chose. Go back and look at my green, orange, and red graph. The use of appropriate documentation, that would be invoices, checks, transfers of funds. Interviews conducted with appropriate parties. Who did the work? Talk to the contractor, the subcontractors. Make a site visit. Go out and look at the property. Use of a common nomenclature. Don't make up your own terms for roof, walls, and floor. Use of a standard numbering system, something that the IRS agent who's auditing this can follow. An explanation of the legal analysis, so that's 1 through 7. We're not done yet. Determination of unit costs and from the engineering takeoffs. Now, takeoff is the engineering analysis of a plan where the architect or the engineer or the contractor will go through and they will count the number of doors, and that's the number of doorknobs they need to put a cost in for, and that's the number of door jambs, and that's the number of hinges. So unit costs and engineering takeoffs, organizing the assets into lists or groups. Don't combine floors with windows. Reconciliation of total allocated costs to total actual costs. An explanation. How did you treat the indirect costs? We got all the direct costs. We got the invoices, right? How about the indirect costs? How about supervision? Oh, overhead? Identification and listing of all the Section 1245 property is different from 1250. Consideration of related assets, aspects. Perhaps there's a change in accounting method. What kind of sampling techniques are you using? All of those 13 elements will be present in a quality cost segregation study. Now, in Chapter 5, we get instructions for the auditor, starting with the risk analysis. Does that sound familiar to any of you? Isn't that what we do if we're performing an audit? Don't we do an initial risk analysis of a financial statement audit? Of course we do. And so the IRS agent is going to do an initial risk analysis of our cost segregation study. There should be a report that summarizes the results of the study. It should provide the background, an explanation of the methodology, details regarding the assets classified, the applicable class lives, and the recovery periods of each of those classes of assets, the rationale and the authority for the property classifications in the study, and then verify the cost basis, conduct a risk analysis to evaluate audit potential, review the report, interview the individual who prepared the report, inspect the property, that is, the auditor does a site visit, review and verify asset classes, research the law, perform your own cost analysis, summarize your findings and discuss those with the taxpayer. Now, this is the moment of truth. Based on your findings and your discussion with the taxpayer, you're going to prepare a final report. And the IRS is going to proceed to assess additional tax, or there's going to be a no change. And it's all going to be based on the good work that the auditor does. Your job, unless you're an IRS auditor and you're watching this little piece of the program, your job as the client's representative is to have done such a very good job working with an expert in cost segregation. Make sure you get that part, that you're prepared to defend the cost segregation study in all circumstances. Thank you for your attention. I promised you one surprise. This is a proposed cryptocurrency bill. I happened to pick this up for those of you that are interested in the Responsible Financial Innovation Act. There are 8 slides following here that discuss what's in the proposed cryptocurrency bill. I am not going to burden you with anything further on the cryptocurrency bill, but rather we're going to terminate this little outing by clicking through those. Pardon me, I hate to do this. Thank you for your time and your attention. There's the email address, there's the phone number. I'm always glad to hear from you. Meanwhile, until next week, please stay safe.